Good morning. It is Friday, May 29th, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic landscape of the Middle East is facing a moment of intense diplomatic anticipation. Overnight, reports emerged that the United States and Iran have successfully hammered out a comprehensive framework for a 60-day ceasefire extension. According to diplomatic sources, this delicately crafted memorandum of understanding aims to halt the destructive conflict that has paralyzed global trade. Under the proposed terms, the agreement would guarantee free shipping through the critical Strait of Hormuz with a strict ban on tolls, harassment, or administrative interdictions. Crucially, the deal mandates that Iran completely remove all naval mines from the international waterway within 30 days. However, the implementation of this historic breakthrough remains in a state of suspended animation. While negotiators have finalized the text, both United States President Donald Trump and senior Iranian leadership have yet to provide their final signatures, with President Trump publicly stating he wants a few days to carefully evaluate the details before committing the nation to the accord.
Transitioning from this high-stakes diplomatic tightrope to the broader global economy, the structural fallout of the recent maritime crisis continues to manifest in severe regional imbalances. In East Asia, the long-term impact on manufacturing supply chains has been laid bare by newly released government trade figures from Tokyo. Japan's imports of oil-derived naphtha, a foundational chemical ingredient used to manufacture plastics, synthetic fibers, and automotive components, plummeted by a historic 47% in April compared to the previous year. This massive contraction was driven by a staggering 79% plunge in naphtha shipments arriving from the Middle East, a direct consequence of the effective closure of the Strait of Hormuz since late February. Economists warn that this severe input deficit is creating an operational drag across a wide range of industrial businesses, highlighting a broader global vulnerability where the prolonged disruption of maritime choke points has triggered persistent pipeline inflation and undermined the baseline productivity of major advanced economies.
This environment of industrial supply shocks and pending diplomatic decisions is reshaping risk assessments across international financial markets. While world oil prices have experienced sharp fluctuations on shifting ceasefire speculation, global capital networks are confronting a secondary systemic vulnerability in the sovereign debt arena. Institutional investors are monitoring a pronounced tightening of credit conditions, as the compounding effects of defense expenditures and elevated freight indices continue to stress public finances. This fiscal strain is particularly evident in Western Europe, where central banking authorities are advising governments to maintain a highly vigilant posture regarding non-bank financial sectors and systemic data gaps. Financial analysts note that the protracted period of high interest rates has significantly compressed sovereign fiscal buffers, forcing capital managers to reallocate funds toward short-term safe haven assets as the market waits to see whether a signed peace treaty will finally unlock a sustained easing of international credit pressures.
Turning our attention to the technology sector, the focus has shifted toward the intersection of cross-border financial integration and the deployment of advanced software architectures. In a major strategic development announced this week, Tencent has formalized an agreement to integrate PayPal payments directly through its widespread WeChat networks. This tourist-friendly move is designed to minimize digital friction for international travelers, enabling foreign users to seamlessly link external credit cards and execute point-of-sale transactions across China's primary digital ecosystem. This operational expansion occurs as tech conglomerates face mounting hardware constraints, forcing an industry-wide reevaluation of data center infrastructure. With computing tasks associated with next-generation agentic artificial intelligence clusters generating unprecedented electricity overhead, tech innovators are aggressively moving away from traditional computing setups, seeking out fundamental architectural efficiency gains to preserve software scalability in an era of deeper geopolitical fragmentation.
Finally, we look at the logistics and global supply chain networks that serve as the vital arteries of international commerce, which are now confronting a fundamental capacity deficit. Maritime data confirms that the global container fleet continues to operate under maximum deployment, with available idle capacity hovering near historic lows as shipping lines remain committed to the longer Cape of Good Hope route to bypass volatile choke points. This permanent detour has completely absorbed vessel supply, locking in elevated transport costs and extended transit times worldwide. Logistics professionals report that even if a binding diplomatic resolution is signed in the coming days, The physical process of clearing naval mines and reorganizing global fleet schedules means that shippers will continue to rely on high-cost regional inventory buffers and multimodal air-rail corridors well into the third quarter, permanently altering the economics of international trade.
In summary, the global landscape is defined by a finalized U.S.-Iran framework deal for a 60-day ceasefire awaiting final presidential approval, occurring just as Japan reports a historic 47% plunge in industrial naphtha imports due to Middle Eastern shipping disruptions. The financial sector remains highly cautious amidst credit market volatility, while China's Tencent expands WeChat payment networks via PayPal integration, and the global logistics industry continues to operate at maximum capacity under the structural burden of extended maritime detours. Based on the current trajectory, I predict that the finalized framework deal for a 60-day ceasefire will ultimately receive President Trump's signature, but its immediate economic relief will be far slower to materialize than financial markets anticipate. While the agreement represents a monumental diplomatic step forward, the physical requirement for Iran to dismantle its naval mine networks over a 30-day window means that maritime insurance premiums and freight indices will remain structurally elevated through June. Furthermore, the massive 47% deficit in industrial raw materials like naphtha recorded in Japan demonstrates that the manufacturing supply chain has suffered deep, systemic damage that cannot be instantly repaired by a political signature. Consequently, input costs will remain firm, forcing global enterprises to maintain their high-cost regionalized inventory models and keeping central banks in a restrictive posture for the remainder of the summer.